Welcome back to the Dorian Finance Podcast, where we discuss finance, business, and much more. Our topics today is what stocks to buy in war, how to build your credit, frequently asked questions, and then our TikTok and YouTube analytics. I'm your host, Dorian, and I'm thrilled to be your guide on your path to financial freedom. Let's get started together. Can you do me a favor and follow my podcast and leave a review of my podcast, because that really helps motivate me and helps the algorithm find more people that will benefit from my content. Before I discuss my thoughts on how to benefit from the wars, I want to say that war is bad and many people have died and will die during these wars. My thoughts and prayers go out to them. From the two recent wars, the Ukraine-Russian war and the Israel-Hamas war, think about what is needed in war. And the answer is really weapons, such as missiles, aircrafts, tanks, high technology that allows you to detect when the enemies attack. And those stocks would translate to Lockheed Martin, Boeing, General Dynamics, and Raytheon Technology. And then I decided on taking another step and looking at, from today's date for about a year, have they actually beaten the S&P 500? Because a lot of times they will say, oh, war is a good time to buy certain stocks because you can make a profit. And I looked at Lockheed Martin, actually has gone down about almost 7% this year. General Dynamics actually went down about 3%. Raytheon Technology, 14% almost. The only one who beats the S&P 500 was Boeing, which almost went up 31% this year, which if you go back further, they've been beaten up from COVID and they haven't fully recovered yet. So that's where we're at on those four different companies. And really the idea of what stocks to invest in war, you could also think of what stocks to invest in during a recession or economic calamity, slowdown, whatever you want to call it. And that's usually the consumer staples, stuff that people have to buy anyways, or utilities, that type of stuff. Other things to just throw it in there. Gold is a good investment because of all the uncertainty in the market. Many investors just straight up buy into it, which will drive up the price of gold. Another is cash. Cash is a good strategy during times of war or recession because companies will be on a discount and you'll be able to buy great companies at a lower price if you're thinking long term. And then it's always, you have to stay informed, keep your eye on the market and also geopolitical developments, what are happening and what the potential risk was. Kind of like how I was able to sell my entire portfolio of stocks before COVID hit the market, and then I was able to rebuy all my stocks at a 30% discount. And it's also, you have to look at your risk tolerance, whether or not if you see your stock go down, let's say 10%, 30%, are you willing to keep it or will you just sell it, panic sell it? And if you're that type of person, if you don't like seeing it go down that much, maybe bonds would be a better suggestion for you. Because really you want to look at the market in a long-term perspective because, okay, wars don't last forever. So in the long term, wars become a buying opportunity. In this episode, I'm going to link also the resources that I use for this as well, because I use US News investment article for this and another website as well that's famous for investing. Those were my sources and you can look at what they talked about as well. Moving on to the next topic, which is how to build your credit. And I created a small promo video, which was the 3 reasons why you want to build your credit, which are financial control, also establishing an emergency fund, and also achieving your financial goals. And you must understand your current credit situation by obtaining your credit report. And there's 3 major credit report bureaus, and all you have to do is like look them up, and then you want to open up a credit card account. And I've created many different blog posts and videos on this, and it'll be linked into the show notes on how to pick the best credit card for you. And you really want to know your credit score first before applying for a credit card, and you want to make sure that you choose a credit card that you'll be accepted in, because anytime you apply for a credit card, they will check your credit score, which will lower it. And then how to build your credit: you have to pay your bills on time, keep your credit utilization to about 30%, which really means, say that your credit limit on your credit card is $10,000, you can't go past 30% or $3,000 on that card. And then diversify your credit mix, which is, okay, I'm talking credit cards, but then there's also loans, personal loans, mortgages, that type of stuff causes a different mix, which will boost up your credit score. Avoid opening up too many new accounts all at the same time. That's also why they recommend not to open up new credit cards before applying to get a mortgage. And usually you want to look at doing only like 1 or 2 new credit accounts per year. Use your credit responsibly. Like I've made comments saying that you want to use your credit cards as if they're cash, or treat them as if it's your debit card, where you're not buying stuff you can't afford to buy, and you're not buying stuff that not necessary. So keep the buying a new TV to only once every 10 years or something, or be responsible with that. And you're buying food, grocery store instead of fast food type of thing. Maintain a long-term credit history, which means if you open up a credit card, you're not going to close out the account. And that's one of the things of picking a good credit card, is you want to choose a credit card that you can keep long-term without it impacting you that much. And also, if you have a friend or family member that have a good credit score, maybe becoming an authorized user will create a higher credit score for yourself too. Monitor your credit score. A lot of banks and credit card companies now will give you free monitoring of your credit. And be patient. I was around 600 for over a year, and now I'm over 700. Not the 850 that people do brag about, which is the highest score, but it takes time to do it. Sometimes it will take seeking professional help if you have many different debts and you want to figure out a way to get out of that hole, and it might be a good idea to do that and consult with someone that is usually a banker, and they'll be able to help give you free advice or low cost advice on how to fix that situation. Frequently asked questions. This one was under my podcast on the presidential election and how it affects stock market. And the question was, why do I care about who is president or not? And really it was, okay, the 2 top runners, we saw both of them as presidents, and we both saw how they affected the economy. Under Trump, gas was decreasing every year and got down to $2 a gallon. And under Joe Biden, it was gas prices increasing every year. Eggs went up about 4 times, if not 5 times the price, and it's still up. And the president is the leader of the free world. And I'll just leave it at that. And then for my video, how to make a budget, person commented, once income is greater than expenses, that's a happy life. Not everyone is that lucky. And personally, I believe that you can be happy with or without money. However, it is about increasing your income, decreasing expenses to create that scenario of income is greater than expenses. Another person commented saying, almost everyone knows how to make a budget, but unexpected things happen at any time. I personally agree with that. However, not everyone puts in place an emergency fund for when unexpected things happen. Like, for example, I had to take my dog to the vet, which cost a lot of money. And because I had the emergency fund, which if you create a budget, it's not about just paying your bills, it's actually creating funds for, unexpected emergencies so you can pay them without incurring too much debt. What are the risks of the FIRE movement? And I'll just state them and then I'll explain them a bit more. Market risk, the stock market goes up and down, healthcare costs, lifestyle creep, return to work. The market risk is when you quit your job, say you're 40 years old, and you think you have enough money to live off of. You think that the stock market's going to keep on going up and up, and then COVID happens or some sort of situation happens that cuts your stock market portfolio in 50%, in half. That's a possibility. Healthcare costs, at least in America, healthcare is tied to your employment, so that could be a lot of money there too. Lifestyle creep is, you might be thinking, I have $500,000, I have $3 million, I can afford to buy a new luxury car, I can afford to buy a boat, I can afford to go on extra expensive vacations instead of doing the cheaper options version. Those are all risks, and the biggest risk is running out of money and then having to return back to work. And usually the risk is when you retire, you're quitting a high-paying job, and when you come back, you won't be able to get that same job again. Those are the risks. Next was, what is it index fund investing? That was a video. And the first one was, the entire half of the video is misleading. I commented, what do you mean? Then they responded that index funds are not for when someone is not confident enough to pick their own stocks. It has been shown time and time again through studies that over 90% of the time a market tracking index fund outperforms stock pickers. It's not lazy or unconfident. It's usually the best overall method, as well the most risk averse. Personally, my podcast is for the person that wants to be that stock picker that beats the market. I'm personally one of them that beats the market. And honestly, the index fund, to me, is good for 90% of the individuals that don't want to put in the time and the effort to look for it. And that's my comment on that. What does the Federal Reserve increasing interest rates mean for the stock market? Simple. Stock prices may go down because of the rotation of investments. When interest rates rise, fixed income investments like bonds become more attractive because they offer higher yields. So investors are there for profit, and they'll take their money out of the stock market and put it into bonds, basically. So stocks go down, bonds go up, that type of thing. Next is the REITs versus high yield savings account. If you're just looking at the dividend from a REIT versus a high yield savings account, yes, the high yield savings account is better because, for example, the REITs, the real estate investment trusts, yield about 3%, and a high yield savings account could be 5% without fees. So 5 is greater than 3, yes. But you have to look at it as you're going to be doing a REIT to get 3%. You're reinvesting back into the REIT, and also real estate tends to go up. So in reality, the price of the REIT should outperform the 5% if that works. Currently, the market, I have looked at REITs, and really it's the price of the REITs just stay and you just get the dividend. So right now, the high yield savings account, in my opinion, probably are better. But again, it's just risk versus reward type of thing. What do you think will happen with the Federal Trade Commission's suing Amazon? I think Amazon will win, or worse, will be hit with a couple $1 billion fine, and then they'll get back to doing their business. Now, if the Federal Trade Commission wins against Amazon, they can break up Amazon, can force Amazon to pay heavy fines and stuff like that. I don't see them having that happen, but who knows at this point. Will AI make everyone rich or just some? I can see AI helping everyone. However, it's also how people use AI. Some people use it as a tool to create businesses and they will get rich. Some will just use it as a tool like Hey Siri or something like that to do some commands, that type of thing. Why did you put yourself on the top financial YouTubers for 2023? Because it's my list. I'm working on becoming one of the best financial content creators ever. So again, it's my list. That's why I put myself there. Bitcoin or gold? I personally like both. I personally have invested in both. But if I had to pick one, I would choose gold because it's safer. YouTube or TikTok? What's with the questions of one or the other type of thing when it's really both? YouTube is safer, the ad revenue is higher. However, TikTok has greater reach and you can get a lot more views per video a lot quicker. If you like my Q&A, please comment on that. And also, if you have any other questions that I didn't cover, please ask them, send me an email, or comment on any of my social media, and I'll try to cover those questions in a later video. Covering my results on my YouTube from October 4th to all the way to Halloween. Video views was 2,500 views, which was 79% more than the previous 28 days. Watch time was 15 hours and 30 minutes, which was 65% more than the previous 28 days. I gained about 16 new subscribers, which was 82% less than the previous 28 days. My top 5 videos, which I'm going to also focus on the AVD, which is the average view duration, because that's what the algorithm kind of wants me to look at. So I'm going to talk about that too. Top video was bad credit loans review with 1,407 views, and the average duration was about 31%. The next video I had, which was my podcast, which it had about 815 views, but only at 2% average duration. I think that was because the bad credit loans was about a minute long video and the podcast was almost 30 minutes. But that I need to get up a little bit more. The next video, which was just me doing a quick test, which was testing a wireless mic with 41 views with a duration of 31.7%, which is not bad. And then I need to create more videos like it and copy it, which was the pros and cons of long-term investing with 37 views, but the duration was 86%. So almost everyone watched it to the end, which was impressive. And then the next one, which was how to increase your income by 1 to 5% part 1 with 21 views, but the average duration was 45%, which means that that's pretty good. My TikTok results was video views of 4,857 views, which was a 14% increase. Profile views was 69, which was a 35% decrease. Likes was 37, which was a 5% decrease. Comments, I had 15, which was a 114% increase, and new followers was -1. I honestly found out that my most active times, my followers are 2 p.m. and 6 p.m., which I'll start posting videos at that time period. If you have any tips or strategies for TikTok or YouTube, please comment below and help me grow my channel more.